Hello, everyone. Thank you for joining us. Welcome to the First Bank Financial Wellness session on understanding credit. Before we get started, I will disclose that what I review here is for educational purposes only. If you do have specific personal finance questions or concerns, please consult with a qualified professional. First, let's think about what contributes to a person's general wellness. Typically, we talk about our physical wellness, spiritual, emotional, intellectual wellness, social, environmental, or maybe interpersonal. What about a person's financial wellness? We often hear about financial literacy, which is a set of skills and knowledge on financial topics, but financial wellness moves beyond just knowledge, and it's a state of being in which you can meet your needs. It helps you feel secure in your financial future and allows you to make choices that let you enjoy life and live well. Today, we'll discuss some important literacy pieces that can help lead you to better financial wellness. In this session, we'll be diving into credit, learning about credit reports and credit scores and how to maintain your credit. A credit report is a document that records your credit history. Companies that prepare credit reports may be called credit reporting agencies, credit bureaus, or credit reporting companies. As seen here, Equifax, Experian, and TransUnion are the three national credit reporting agencies. If you have a credit history, you probably have at least 3 separate credit reports. You have the right to these reports, and we will talk about this later in the session. In addition to these 3 national credit reporting agencies, there are also specialized consumer reporting companies. They offer reports that help other companies make decisions regarding providing consumers with products and services. These could include financial institutions, employers, landlords, insurance companies, and cell phone companies. So what does a credit report look like? Credit reports have different formats depending on which agency it is pulled from. However, they will all have 5 sections in common. Let's go through a sample report now to explore. First, we see here information about the consumer, you. The identifying information will have your name and any names you used in the past in connection with a credit account, including nicknames, your current and previous address, your date of birth, social security number, telephone numbers, and employment information in some cases. Section 2 shows public records information, including court-related financial information, such as bankruptcies and foreclosures. Next, accounts that have been assigned or sold to collection agencies make up their own section. When the original creditor decides it's no longer worthwhile trying to collect payment from you, then it or the company it transfers the debt to may have a collection agency try to collect the debt. The credit account section has the most information, sometimes called accounts, trades, or trade lines. It includes information about current and closed accounts, the types of accounts you have, including installment accounts such as auto loans and mortgages, and revolving accounts like credit cards, the credit limit on the accounts or the amount of the loan, terms of the arrangement and the payment amount due, account balances, account payment history, often called the payment pattern, the date the account was opened, and if applicable, the date it was closed, and the name of the creditor. The fifth section, inquiries, includes requests to review your credit. An inquiry is created when a creditor reviews your file. The inquiry section will generally list the name of the company that requested your credit report and the date the request was made. This section may list when your credit report was viewed in response to your application for a credit card or loan, or when you offered to co-sign a loan. This is called a hard inquiry because it may have an effect on your credit scores. Sometimes your information is supplied by the credit reporting agency to businesses so they can offer you credit, insurance, or a job. This is called a soft inquiry because it has no effect on your credit scores. Now that we've gone over what you can find in your credit report, we're going to play a little game. so I hope you are paying attention. With each of our items listed here, there are 5 that can be found on your credit report. As I go through them, I'll pause so you can decide first if they can be found on your credit report or not. Number 1, your name. Yes, your full legal name can be found in the personal or identifying information section. Your age? No, but your birth date is, so someone could easily calculate your age. Arrests and convictions? No, they could be on employment background checks made by other consumer reporting agencies, though. Credit card payments? Yes, these are listed along with the name of the financial institution that issued the card and other account information. Your income? No, your income is not listed on the credit report. Bankruptcies? Yes, they are listed. Cell phone plan payments? Usually not. However, if you did not pay your bills on time, the late payments will likely end up on your credit report. Debt to income ratio? No, however, lenders can use debt information from the credit report to calculate the ratio themselves. Student loan payments? Yes, payment history for federal and private student loans is included in a credit report. These loans are also included in the credit reports of people who co-sign student loans. Credit card limits? Yes, credit card limits are included along with the total balance and the estimated minimum payment owed. Traffic tickets and fines? No, these are generally no longer reported on a credit report. The same is true for unpaid gym memberships that have gone to collection. You still need to pay your debts, but these items are no longer included in credit reports. Savings account balance? No, these are not included in a credit report. Checking account balances are also not included in a credit report. Debit card purchases? No, debit card purchases are withdrawals from the checking account. These purchases are not listed on a credit report. As you can see, these 5 items are listed on your credit report. Credit scores are a number that give a snapshot of your credit history at a point in time based on information in your credit reports. Generally, the higher the number, the better your credit history. People who have higher scores are likely to pose less risk to creditors than people with lower credit scores. Lenders and others use credit scores to predict how likely you are to pay bills and debts on time and as agreed. They use credit scores because it makes the decision-making process more efficient. Rather than reading through one or more credit reports, they can simply look at a number. Like the credit reports, there are several producers of credit scores. If you have a credit history, you likely have several different credit scores. So why are credit reports and credit scores important? Because different types of companies will use them to determine how you can access credit. Let's review a few examples. Financial institutions use credit reports and scores to determine whether you can get a credit card or other type of loan. They also use them to determine your credit limit or the maximum amount of money they will loan to you. Some also use credit reports to decide if you can open a checking or savings account, or what type of account you can open. Landlords might use them to decide if they will rent an apartment to you and perhaps to set your security deposit. Individuals with credit reports that have negative information may not be able to rent some apartments or may need to pay a high security deposit or have someone co-sign the apartment lease. Utility companies can use them to decide whether you will have to pay a security deposit and the amount of the deposit. Some cell phone companies use them to determine your eligibility for their plans. Individuals with credit reports that have negative information and low credit scores may only be offered prepaid or month-to-month phone plans. Some states allow insurance companies to use information from your credit reports to decide whether they will sell you insurance and how much it will cost. Some employers might use them to perform background checks for potential employees, depending on state law. To find out if credit information can be used in employment decisions in your state, you can contact your state's Department of Labor. And some state agencies or affiliated organizations may use them to determine eligibility for some professional licenses. Credit reports and scores may also be used as one factor for risk-based pricing. Other factors can include your employment history and outstanding debts. With risk-based pricing, lenders set interest rates and other loan terms based on the estimated risk that a particular consumer will not repay the loan as agreed. Lenders may charge you a higher interest rate if they view you as a higher risk borrower, perhaps because you are several payments behind on a mortgage or credit card, you don't have reliable income, or you have declared bankruptcy. And lenders may offer you a lower interest rate if they view you as lower risk, perhaps because you have a high credit score and stable employment. A lender must tell you if they use your credit reports and scores to make a lending decision about you, or if they offer you less favorable terms than other borrowers based on your credit reports or scores. If the lender denied offering you credit, you will receive an adverse action notice. If the lender offered you less favorable terms, you will receive a risk-based pricing notice. The notice must provide information about how you can get a free credit report, the specific credit score they used to make their decision, the score range, and the negative factors affecting the score. This report is in addition to the free credit report you are entitled to every 12 months from each of the nationwide credit reporting agencies. So, are credit reports important? Let's take Anna as an example and learn. Anna was convinced that credit reports didn't matter. She didn't plan to get a credit card or any kind of loan. She used cash for everything. Anna recently moved and needed to find an apartment. Some landlords wouldn't rent to her because she had no credit history, even if she promised to pay rent in cash every month. When she found an apartment she liked with a willing landlord, she had to pay a larger security deposit because she had no credit history. She also had to pay a deposit for her utilities because she had no credit history. So yes, credit reports and having a credit history are important. Having a credit history provides information to lenders, property managers, and other businesses to make certain decisions about you. Not having a credit history may mean you won't have access to products, services, apartments, and possibly jobs. Having a good credit history allows some products or services to be cheaper. Without a credit report, you will not have a credit score, which is used to make many decisions. Now that we know having a good credit score is important, how do we manage to improve that figure? Let's first see what factors are calculated in that score. Again, there are multiple producers of credit scores. Therefore, you likely have multiple credit scores, not just one. Each entity that provides credit scores has its own proprietary calculation or model. You may have heard of the FICO, Fair Isaac Corporation score, or Vantage score. There are others as well. No matter the model, the two significant factors affecting your score are if you repay debts on time and as agreed, and how much you currently owe from each account compared to the credit limit or original loan amount, which is called your credit utilization rate. Additional factors include how long you have had your current loans and credit cards and the types of credit accounts you have. For example, managing both a credit card and an installment loan, such as for a car, could be viewed more favorably than just having one of those two loans. The different types of credit accounts you have is called your credit mix. Here's how FICO weights information from your credit reports in its general credit scoring model. Payment history accounts for 35%, amounts owed, 30%, length of credit history, 15%, your credit mix, 10%, and the new credit is 10% as well. Knowing what factors influence credit scores allows us to understand what causes the score to go up or down. Let's look at some situations and determine if they will make a credit score go up or down. Juan is late with his credit card and cell phone payments for a few months. How will this affect his credit score? Juan's credit score will go down. Falling behind on payments can greatly hurt credit scores. Peter nearly reaches his credit limit on his only credit card and is making minimum payments only. This will cause Peter's credit score to go down. Peter is making minimum payments on time. That is good. Unfortunately, his credit scores are still likely to drop. This situation affects the credit utilization rate, which is the percentage of available credit used at any time during the month, even if you pay the balance in full by the due date. Carrying high balances on credit cards compared to available credit limits can significantly reduce credit scores. Patrick files his taxes early and receives a tax refund. He uses the refund to pay down his credit card balances. How will this affect his score? While the amount he paid is unknown, any payment made to reduce a credit card balance is good. Positive behavior will not instantly increase scores, but can set your score on a course that will gradually trend upwards. Missing payments, using too much credit, and generating inquiries can cause instant decreases in scores. Increasing scores takes longer. After taking a financial wellness course on credit, Maria orders her free credit reports from annualcreditreport.com. How will this affect her score? There will be no change. This is a right given to you by the Fair Credit Reporting Act. Reviewing your own credit reports does not affect your credit score. After reviewing her credit reports, Penny realized that she does not use her oldest credit card. She closes the credit card account. How will this affect her credit score? Go down. By closing her oldest account, she is shortening the length of her credit history. Different lenders, businesses, and service providers use different criteria for what they consider to be a good credit score. FICO scores range from 300 to 850. FICO offers this chart to help estimate what scores in particular ranges may mean, from exceptional, very good, good, fair, and poor. The higher your credit scores, the more likely you are to qualify for credit, rental housing, insurance, and in some circumstances, employment. Your credit scores can determine if you will be able to borrow money and how much it will cost you. Good, very good, or exceptional credit scores provide access to most products and services. It's important to note that your credit scores are not a reflection of who you are. Rather, they reflect how you have handled your financial obligations in the past. Having high credit scores also does not mean you are financially stable or that you are successful. High credit scores simply mean that you present a low risk to lenders and others who use credit scores to make decisions about you. You also have the right to accurate information in your credit reports. The only way to determine if the information is accurate is to get and review your credit reports regularly. Federal law requires that the 3 national credit reporting agencies' credit reports are available. Again, there are other companies that generate credit reports, but these consumer reporting agencies provide you a copy of the information in your report if you request it. The law gives you the right to one free credit report every 12 months from each nationwide credit reporting agency. Remember, we mentioned there are 3 nationwide credit reporting agencies: Equifax, Experian, and TransUnion. These are the most widely and frequently used. You can order credit reports from these agencies from annualcreditreport.com. This is the only place where you can get the free credit reports from the 3 nationwide credit reporting agencies that you are entitled to by law. You can order online, or by calling, or through the mail. Some people order their 3 credit reports all at once. Others choose to order one from their credit reports every 4 months or so. By ordering them throughout the year, you can catch errors or spot evidence of identity theft more quickly. An easy way to remember to order your credit reports is to order one on New Year's Day, another on Memorial Day, and another on Labor Day, January, May, and September. Again, you can get reports from a third-party website, often advertising free credit reports and scores, but these sites are not required by federal law to provide free credit reports. So when in doubt, use annualcreditreport.com to order your credit reports. Credit reporting agencies can make mistakes. There may be errors in your credit reports. You are the best person to identify errors in your credit report. Here are some common errors and where to find them. Identity errors. Check the credit accounts, trade lines, or collections section of your credit reports for these errors, such as errors in your identifying information, wrong name, phone number, address, social security number, or accounts belonging to another person with the same or a similar name to yours. Errors related to the incorrect reporting of account status. Check the credit accounts, trade lines, or collections section of your credit reports for these errors, such as closed accounts reported as open, open accounts reported as closed, accounts reported with you as the owner when you are actually just an authorized user, accounts incorrectly reported as late or delinquent, incorrect date of last payment, date opened, or date of first delinquency, and same debt listed more than once, possibly with different names. Errors resulting from data management can include incorrect information that appears again after it had been corrected, accounts that appear multiple times with different creditors listed. This is a common error for accounts in collections. Make sure the balance is listed as 0 with the original creditor if there is a balance listed in the collection section for the same account. Balance errors can include accounts with an incorrect current balance, which is the money you currently owe. When payments are reflected in the balances depends on when you make the payment, when the payment is posted by the creditor, and when the information is transmitted to the credit reporting agency. Errors related to the reporting of outdated information. For most accounts, negative information can only be reported for 7 years. Some bankruptcies can be reported for up to 10 years. So remember, if you do find errors, dispute them immediately. Now, how do you dispute those errors you find? Option 1, use online forms on the Equifax, Experian, and TransUnion websites. Go to the website that had the incorrect or outdated information on your report. If the same incorrect information is contained in more than one report, you should claim it on each agency website. Option 2 is by mail. Send a letter to the credit reporting agency that is providing the incorrect information by certified mail with return receipt requested. If the same incorrect information appears in more than one report, you should claim it in a separate letter for each agency. Many financial advisors will recommend the second option, by mail with a receipt. Make sure to keep a copy. This ensures you have a paper trail detailing when the credit reporting agency received your dispute. Now, why is it important? Credit reporting agencies must investigate the claim within 30 days of receiving it, unless they believe the dispute is frivolous. If they think that, the agency will notify you in writing. Remember, the claims process takes time. Keep records, follow up, and don't give up. Now, your credit history does not have to be your credit future. Some tips to repairing and improving your credit are listed here. Request copies of annualcreditreport.com credit reports at least once every 12 months and make sure the information is correct. If there are errors, dispute the errors with the credit reporting agency that is providing the incorrect information, either online or by mail, as we discussed. Pay bills in full and on time. If you do this, you will have the greatest effect on both reporting and credit scores. It is the most important strategy for maintaining a good credit history. Continue to pay down your debt balances. Keep old accounts open if possible. Older accounts create a longer credit history. Applying for too much credit at once can suggest financial problems. Lenders may not consider it favorable when applying for credit. And keep good financial records. Good record keeping will give you proof if there are any errors on your credit reports, information if your identity is stolen and you have to contact your creditors quickly, and most importantly, peace of mind. You can also get help building, repairing, and improving your credit history, but be careful when asking for help. It's helpful to know that credit repair companies, for a fee, promise to fix your credit, often disputing some or many items on your credit reports. This is something that you can do on your own for free. Also, debt collection businesses offer different services, often in debt consolidation, loans, or debt settlement services. Debt consolidation involves taking out a new loan to pay off some or all of the debts you have. Debt settlement is working with your creditors to make an arrangement so you owe less money. Many of the businesses that offer these services charge a lot of money you could use to pay down your debts. So beware of credit repair companies when they promise to remove the bad credit or remove other negative but accurate information from your credit report. No one can have accurate information removed. Or when they promise quick and easy credit repair. When they offer to create a new identity for you, if you provide false information or use a fake social security number to apply for a loan, you will be committing a crime. Or if the company wants you to pay upfront costs for credit repair services before providing you with any services. Some companies running a scam ask for upfront costs and never provide a service. And finally, if they do not explain your rights and what you can do on your own. Remember that you can order your credit reports and scores by yourself. If you find errors in the reports, you can file your own dispute. If you do experience fraud or identity theft, or learn that your credit information was exposed or stolen in a security breach, there are some strategies here to help. One option is an initial fraud alert. This is a good option if you are concerned you may become the victim of identity theft or fraud. An initial fraud alert requires creditors and other businesses to verify your identity. This is the additional protection it provides. The alert is free and stays in place for 1 year. After it expires, you can create another one if you want. An active duty military alert is similar to an initial fraud alert, except it's only available to active duty members of the military who are deployed. The alert is free and stays in place for 12 months, but can be renewed for the length of someone's deployment. If you have been the victim of identity theft, you can place an extended fraud alert. It is also free and provides the same protection as an initial fraud alert, except it stays in place for 7 years. To place an extended fraud alert, you must provide proof of identity theft and a copy of an identity theft report. You can create an identity theft report at the Federal Trade Commission's website, identitytheft.gov. If you want more protection than a fraud alert, you can consider a credit freeze. You have a right to freeze your credit by law. A credit freeze prevents access to your credit reports. This prevents new accounts for credit from being opened, and in some states, stops new accounts for other services, such as insurance and utilities. You would need to lift the credit freeze if you want to apply for credit, a job, or something else that requires access to your credit reports. This means you must plan ahead because it takes 24 to 48 hours to lift a freeze. There's no cost to place or lift a freeze, and it lasts for at least 1 year. For a freeze to be most effective, you must place a freeze at each of the 3 nationwide credit reporting agencies. Unlike the fraud alerts, putting a freeze at one nationwide credit reporting agency does not automatically extend to the other 2. Finally, a credit lock may be an option for you. A credit lock is similar to a credit freeze, except this is a credit reporting agency product, not a right provided by law. It may be easier to lock and unlock your credit than freeze and unfreeze it. Credit reporting agencies may offer a credit lock for free or for a special price during an introductory period. After that introductory period, the cost of the credit lock may go up. Here are some additional resources used in this session and for you to explore to enhance your financial wellness. Thank you for joining for Understanding Credit.